Wall Street, top investors watching your money. Joining me now is Michael Lee Strategy founder Michael Lee. Also with us here on set, Greg Farinello. Greg, I do want to start with you on what we're seeing in the futures market this morning. Mike Lee, I don't know. Let's talk about a story stock. This is a company I know you follow, and it's Tesla. Global deliveries, we found out over the weekend, surged 83% in Q2. A record 466,000 vehicles delivered to customers around the globe. And the stock, look at that this morning, it's up 6.53%, Mike. That's a big, big move on Tesla this morning.
Yeah, look, the argument against Tesla is, it has been for forever, is they simply can't produce enough cars to keep up with their demand. That along with valuation. But Tesla has a history of outperforming these production targets, beating the street in terms of deliveries, for years now. And you have to think that that makes sense. It's simply an engineering problem that, Elon Musk is a pretty spectacular engineer, and he's got a very smart team of people over there. So figuring out these production log jams, was never going to be that much of an issue. And when you have this much demand for these types of cars, they're still behind. There's still far more orders out there than there are deliveries. When you have this demand, you got a lot of runway in front of you. My only issue with Tesla is the valuation of the stock. You could have bought this stock at 130 bucks earlier this year. Now we're trading close to 300, and so this is a stock whose valuation has historically been pretty astronomical in terms of how high it is. But if you're gonna grow your deliveries 70 or 80% year over year to keep up with that type of demand, you can see why it gets a premium valuation. But I think Tesla's stock performance is very much indicative of the overall market. It's a lot of these big mega cap tech names, the most widely owned names, were very oversold at the end of last year, and they've simply been off to the races this year in light of an overall market that has declining earnings, tightening liquidity, slowing economy. Those sorts of things typically result in multiple contraction, and we've seen multiples expand by over a third since last fall. And I'm sure some of that is fair, but the rest of it seems to be a bit in excess, with the Nasdaq having the best first half they've had in history. Historically, when that happens, that tends to continue. But you have to wonder at some point, what is the market going to be too expensive? And as Greg just mentioned, a lot of the economic data coming in hotter than expected. That's going to force the Fed to continue raising rates and stay higher for longer.
I don't know, Greg, do you agree with that? Because I think you could make the case on both sides about the Fed. And the reason I say that, that would affect, you would think, some of these big 7 technologies stocks that have really powered us up through the first half of the year. I think listening to you and Mike, I'm thinking diversify. That's the thing in my head right now is diversify. If I listen to Mike and Greg this morning.
Diversification is always a good thing. Look,